population, then you have sampling. Now, sampling here, what it means is that you are testing less than 100% of the items in the population. And the testing is such that they will have an equal chance of representing the entire population. That is what we call sampling. So with audit sampling, we test less than 100% of the items. But that small items that we have tested, it should be able to represent the entire population from which we selected the item. That is what we call audit sampling. It most of the time, you share a mark because of time. So what you do is that you sample based on your expertise. And this sampling and also a risk. It is a very big sampling risk. He actually said there is the likelihood said items now are selected for sampling. It may not represent the entire population, and that means that the result of the sampling, may be ineffective. To base your decision on. So that is for the sampling. Now, with audit sampling, we have the statistical and non-statistical audit sampling. Now, most of the time, auditors, what we normally do is the non-statistical sampling. So with the non-statistical sampling, it is based on the auditor's experience and judgment. So the auditor will just, based on his experience, when you endorse a better sample, you have invoice 1 to 100 money. Then you have also 1 to 50 pounds. It's based on the auditor's judgment. Another auditor will come. Most of the time, the statistical sampling is a problem because the judgment. Then we have what we call the non-statistical sampling. The statistical sampling. With the statistical sampling, we use a probability method. We use a statistical method. It's an audit judgment. We have a system, a computation on item to select. So it's based on statistics. Well computed statistics. It's an auditor or judgment sampling. So that's the difference between statistical and non-statistical sampling. Now, in selecting the sample size, the auditor considers certain factors. One, the auditor considers the sampling risk. The auditor considers the population size. Then, we also consider the sample size as well. And then, we have something we call tolerable error. It deals with the amount of errors in the population that the auditor is willing to accept. Then, the auditor also consider the purpose of the audit. All these are factors the auditor considers in the sampling. We have some sampling methods which you can study that. We have the random sampling. These ones, we are not going to spend so much time on that. We have the random sampling, as the name implies. Then we have the systematic one, which is like the systematic sampling. We have the haphazard sampling. These ones, will not be added in the relevance. This for level 2. Now, let's talk about audit documentation, which we have also talked about it previously. Audit documentation is working papers. It's at 2:30. And last time we discussed working papers. And I said that working papers, they are all documents. Any information used by the auditor in executing his work, from which conclusions are drawn, they are all audit evidence. So any information here, every auditor na man na every conclusion, opinion, audit evidence. So information used by the auditor himself, information requested from the client, they are all working papers. And we explained that working papers are divided into two. We have the current working papers and we have the permanent working papers. And we said that the current working papers, they are documents that is being used by the auditor that relate to only the current period. So what it means is that after the current period work, it may be of no essence to the auditor again. That is the current working papers. But with the permanent working papers, it is of continuing use to the auditor. It means that from period to period, from year to year, the auditor will continue to rely on that. The auditor will continue to use that. And we gave example like organogram, organizational structure. And I said that if you are an auditor, you go to a client. Every year, you request for organogram. It means that you don't know what you are doing. Because what are you using organogram for every year? You have filed the organogram in your audit file. Meanwhile, it's the same information. Nothing has changed. The organogram has not changed. And every year you continue to request from the client. What are you using it for? So those ones, you request for it once, unless there has been a change, which is mostly not likely. Now, the benefit of working papers or audit documentation, we also mentioned that it enhances the quality of the audit. It also assists the audit team to plan and perform the work. When there is a documentation, it shows that a quality audit work has been done. When there is documentation, it helps you to plan the work. It helps in planning the work. It also assists supervisors in directing and supervising the audit work. The documentation facilitates effective review and evaluation of audit evidence. Documentation keeps records of matters of continuing significant future audit. So when there is documentation, it gives records. So at any point in time, if I am not there, the following year somebody goes through my working papers. He will have records of all the work I have done. So if there is anything to correct, if there is anything to learn from the working papers, the person will have all those information. So it keeps records. Documentation also ensures that members of the audit team are accountable for their work. So when there is documentation, it makes the team members accountable for their work. Because in the working papers, it is specified. Allocation of responsibility is documented. Now it is a BBC na efficient. Yes, one acquire revenue, no. One acquire procurement, no. One acquire tax audit, no. Because you are documenting our working papers, you will be able fast. When acquire, it's just like now what the PAC have been doing. Nowadays, at PAC, they call the auditor. So if there is an issue, now say a bank audit report, now public account for share. A fair client in that obijina or not obisa. And then unaccounted revenue 600,000. Dientina DC ana MC ana headmaster ana headmistress dientina utina wa 600,000 ska one to your accounting. No amount in Sasso. My Lord. My job. I say me, Scabby, you are me accounting, sir. Sir, who accounting here? Mufro auditor no yes edwuma no la. You wo ma ni abefro. Na wo so aba. Say say no me no. Na wo so aba be ma evidence. When the evidence probably are yes because we couldn't provide any evidence. But when there is documentation, audited human, any aspect you need to document to the conclusion of the work. So content of working papers. I mean, we have the information in understanding the entity. Those ones we all know, the organogram and the rest, legal document, the audit programs, the checklist, correspondence, copies of the financial statement, copies of communication, ratio and trends. All these things, they form part of the content of the working papers. Rates of restatements, the nature, timing and extent, they are all part of the working papers. Now, let's look at automated working papers. Last time I explained this, and I said that nowadays, in the olden days, there was nothing like computers. We were using rule sheets, that big sheet, to record our documentation. But now, because of technology, working papers have been automated. In fact, currently, there is something we call AMIS, Audit Management Information System. What it means is that now there is a software that all the working papers, it has been coded into working papers. They say, produce Excel. Our system so that say competence and our team members, you just key in the names. That is all. The following year, if maybe there has been change, you just change one other figure. Now that is automated. Now you are called the data. You are just here that. Into BBI so are called the data. Now if I say what's on the same, errors are reduced. When you use the automated, it reduces a lot of errors. Unlike manual one, obey rule sheet. No, I know a mistake, never true. No, I know a mistake, never true. No, do the eraser. But they are coming to tell them, so no, we cheat. The permission sound, we want to take. Send your money in a job. Working papers will be neater and easier to review. And then time is also saved. It saves a lot of time. Okay. So these are some of the benefits. Now let's look at related parties. Related parties. Related parties. I hope that most of you know related parties because it's in corporate reporting, isn't it? So you standard then a cassava. Related parties. Standard then a cassava related. IES 20. Hey, Monka. IES 24. And a cassava related party. I can't disclosure and answer the disclosure. Now, related party, one of the ways I want to test our audit, related party, how to audit related party transaction, or how to identify related party transaction. Now, you all know related party. Two parties are said to be related if they are all under common. If they are under common what? Two parties are said to be related. Okay, we'll be defining related party. One guy. So parties are said to be related if one party has the ability to control the other or exercise significant influence over the other party in making financial and operation decisions. So we are saying that parties are said to be related if one of the parties has the power to control the other party. We have consolidated account. So control is significant influence. And so one person will make us. If one party has that power to control or have significant influence, then there is a related party. Now, a related party transaction is a transfer of resources or obligation between related parties, regardless of whether a price is charged. Example of related parties, you have the directors and management, their families and others, which we know. Now, there are some risks associated with related party transactions. One, most of the time, related party transactions are complex. They are one of the risks involved in related party transactions is the complexity of the transaction. Two, the accounting system may not be effective at identifying and summarizing related party transactions. It's one of the risks. The system in place may not be able to identify related party transactions. And three, related party transactions may not be conducted at arm's length. And that is one of the major reasons why auditors are interested in related party transactions. Those of you who are doing taxation, we have something called transfer pricing. It is one of the major things nowadays multinational companies use to evade taxes. And that is why there is a separate law now on transfer pricing. So you can't just say that I've given loan to my subsidiary. I gave loan to a subsidiary. Then they will give the loan at a certain percentage. A very high percentage. No, so mama, subsidiary loan. Go through their records is there at, let's say, 35%, 40%. Now, so we must payment must subsidiary loan. The tax implication is that because loan is a deductible expense, isn't it? Is the interest on the loan is a deductible expense. So because it has been given at a higher rate, it means that the interest expense will go up. When the interest expense goes up, the profit will reduce. And when your profit reduces, your tax will reduce. And nowadays, GRA is very strict on transfer pricing or companies that are related because of these transfer pricing issues. So the auditors are very interested in that. Now, the reason why the auditor wants to have idea about related party transactions, there are those we have mentioned. So the objective of the auditor with respect to related party is to understand the entity's related party transaction. You want to understand how the transaction happened. How did it happen? How did it occur? What are the relationships between the related parties? We want to know because of the nature of the related party transaction. And we want to know whether there is sufficient and appropriate audit evidence about the related party relationship and transaction. If you are related party ground, so why are you careful? You will never see any related party transaction in the financial statement. It's difficult to see. Most of the time, they will hide it. Last time I gave an example of error. I hope you are all aware of the error case. Yes. Yes. How the issue came about. It was this related party issue. They created an SPV. You know SPV, special purpose vehicle. NOSA loan. So they were using that SPV to contract loans. And they were not consolidating that SPV in their financial statement. They hid the information. And the auditors also couldn't see anything. They couldn't see it. After some time, the company collapsed and they sued the auditors. And then at the end of the related party. And from there, and Omusha says no, Now, it is not about that, from that Anderson case in ACL and AFI consolidated financial statement. It first, it was even about control. First, now we consolidate here. Now it was just about who controls. But now it's not about control. If I am dominating the major decisions of the organization, and if I don't have control, indirectly I have control. That is the meaning. So what it means is that any decision is being undertaken by A. A is what? Just 30% interest. But decision, all the major policy decisions by inference, what it means is that A has control. So now it is not necessarily about the shareholding structure, but for your exam, you should know. But I'm saying that in practice, it is not about that. That is not the main factor for consolidating. You look at dominance. Who dominates? Who has the veto power to make decisions for the organization? Procedures to identify related party transactions. This is very examinable. Audit procedures, Audit procedures to do this. Audit procedures to identify subsequent events. Audit procedures to identify going concern. Those audit procedures, I don't know, a young level. So you need to take note of this, especially this one. Procedures to identify related party transactions. A back pass question, I repeat here. So you need to know the audit procedure. At least you should know 5 of them. 1. Review the prior year working papers for names of known related parties. So one of the audit procedures is that review the prior year working papers to know the names of related parties. It's one of the procedures. 2. Review the entity's procedures for identification of related parties. Review the entity's procedure for identification of related parties. 3. Inquire as to the affiliation of directors and officers with other entities. So you inquire from them. Do we have any director or any other management who has interest in this company? You want to find out, you want to make inquiries. It's one of the audit procedures. The auditor must do it. Because it is an audit procedure, you as an auditor, you must follow it. 4. Review shareholder records to determine the names of principal shareholders, or if appropriate, obtain a listing of principal shareholders from the share register. So especially if you are auditing a PLC, you need to review all these things. The shareholders register. Don't say, who review shareholders register? Don't say, senior management, or more than a shares in here. I want some CBA. You want to say before there is a related party transaction. 5. Review minutes of the meetings of shareholders at the board of directors and other relevant industry records. This thing I've been saying this over and over again. Now, most of the time, if you want to get information, ask for minute books from the client. As you read the minutes, you come across so many sensitive issues in the financial statement. But in recently, I went to complete some final audit somewhere, and then I said they should bring me the minutes, the recent minutes they had. Then, when I was reading, before that, when I was doing the interim audit, one of the schools, I called all the teachers, those who are occupying government bungalow. You know, some of the teachers, they stay in the schools. Then, when I called them, I said, please sir, I've seen that you are paying rent 50 cedis a month for 2 bedrooms. 60 cedis. 80 cedis. And with that money, for the past 6 months, we are all not paying. So I'm going to increase it to 150 Ghana. They said, they told me that, why should I tell them like that? Why should I, who am I to tell them that they are going to increase the rent? It should come from Ministry of Education. Hey, they were furious. So about to a time, I said, I will make sure that this fee will increase it. Because what they were saying, the same teachers, they are paying 500 cedis outside. You are on campus, you are paying 60 cedis, and that one you are not paying. You are living, you are using water, you are not paying. When I went there, the board also had done some meeting, and they said that they have increased it to 150 cedis. Someone said, who am I? And I wrote it for the board recommended. Then they can pay 60 cedis.
Why in here?
It's acceptable. What is taking? Again, review the entity's income tax returns and other information supplied to the regulatory agencies. You can also review that. You review the income tax returns. You see a lot of information. For shareholders, they are supposed to file annual returns. Okay, so if you review the income tax return, you will get information on that. Then inquire also about the relationship between directors and other entities. So you find out whether any of the directors are related to any other entity. And you see that there is a related party issue. Now, last time I was explaining this issue that came up, SML. You've heard of SML issue, Strategic Mobilization Limited. The issue with Ministry of Finance and Engineering, where they are saying that they are paying a lot of money to SML for no proper work being done. Over $50 million every month to SML. That money, we went to IMF for $3 billion loan. You are paying $50 million every month for a contract. What is wrong with us? But this one, you can't say it. You see, but you see, it is a related party issue. It's a related party issue, which they are all aware of. It's a related party issue. So let's end it here. Now, if the auditor discovers that there was an unidentified or undisclosed related party transaction, the auditor must undertake the following procedures. 1. The auditor must determine whether the underlying circumstances confirm the existence of those relationships or transactions. So here what we are saying is that, let's say that 2022, the auditor was not able to determine any related party transaction, even though there was a related party transaction, but the audit procedure couldn't detect that. It's detection risk. Then, in the subsequent audit, the auditor was able to identify some related party transaction. So here we are asking that, on what procedure did the auditor undertake to identify related party transaction for the current year, even though for the previous year there was no identification of related party transaction? And we are saying that here the auditor should determine whether the underlying circumstances confirm the existence of those relationships or transactions. So the auditor should find out whether those relationships already existed in the previous Yes. If so, two, the auditor should communicate the information to the audit team. So if the auditor is able to prove the existence of related party transaction, the auditor should inform the entire team members. Let them be aware that there is a related party transaction. They should all watch out. 3. Request management to identify all transactions with the newly identified related parties. So if there is a related party